Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 413 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about investment grief. And much of this is just simply due to the fact that many of you have lost money recently, right? I have lost some money recently. But some of you have lost more money than others because you've put money into more speculative investments or whatever it may be. We want to get right down to how we feel about our investments and how we grieve over the loss of money in investments over time. And so hopefully this is helpful to you to get over some of your losses or to move on from some of your losses or to better understand why you took losses in the first place. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, let's be real. The investment landscape in 2022 is just different than it was in 2021, right? Things have changed. Things are different. Things don't always stay the same. In our investing lives. Things can change on a dime, and things that we thought would continue forever just don't continue, right? The growth story that we heard throughout the pandemic just isn't around anymore, right? The growth story that we heard through the longest bull market in American stock market history just isn't around anymore, right? People have traded in stocks like Tesla for stocks like Berkshire Hathaway, right? And the market is just absolutely not in the same place that it was back just a couple of months ago, right? The market has definitely changed, right? You just do some check-ins on your major indexes year to date, right? You've got multiple that are in corrections. You've got some that had even pushed up against bear markets. And, you could argue that if just a couple companies, the Apples of the world and the Microsofts of the world weren't doing what they continue to do, then you would see bear markets in some of these major indexes. But we do not. But there were several people, 2020, 2021, saying you should go all in on some things. And many of them did, right? You should go all in on Tesla, right? Now, this is not to talk about Tesla's business. I'm not saying it's good. I'm not saying it's bad. I'm not talking anything about Tesla other than using it as an example as to how if you get too caught up in a specific narrative, that things can hurt, right? So you just look, year to date, Tesla stock, being down over 30%, right? It opened the year at nearly 1,200, and now it's down in the 800s, okay? So that's a stock that's been cut quite extensively. You look at the ARK Innovation Fund, right, ran by Kathy Wood, right, the darling of the pandemic, that opened this year at 97 and is now down in the upper 60s. It's been fluctuating upper 60s, lower 70s, right? But that particular fund got as high as 160-ish, right, at its peak, which was February of last year. So we've seen quite a come down from some of these major speculative assets. Not to mention, if you just want to talk about speculative assets, just go to Bitcoin, right? Go look at Bitcoin, go look at Ethereum, go look at some of these cryptocurrencies that have basically been cut in half or nearly cut in half from their highs, right? Now, sometimes these are things that we just have to deal with, right? But many times when we have some of these major losses that I've talked about here, There are things to learn from, and there are definitely things to grieve over, right? Because losing substantial amounts of money, and especially making those sell decisions to lock in the losses for losing substantial amounts of money, can absolutely hurt. And so what I want to talk about today is investment grief and the 5 stages of investment grief. Now, the outcome of some of these situations just feels sickening, right? You can take some absolutely brutal losses, but ultimately, there are ways to cope with what's going on. And they come from Elizabeth Kubler-Ross and her 1969 model for coping with terminal illness. Okay. And by no means is investment losses in the same world as a terminal illness. But when we are dealing with loss, it's important to look at them through these particular lenses. Okay. So the first step the first stage of investment grief is denial. Right. Now, this is typically a short-lived stage. And man, I'm just telling you, reading through some of these stages, you can, if you've been investing for any period of time at all or through any different markets at all, you can absolutely, believe that these are the case. So denial is usually a short-lived stage. Investors express disbelief. While temporarily denying reality, common responses include, "This can't be happening," and "I refuse to accept this." However, when reality hits home, most soon move on to think about the implications of, quote, "the event." Now, the event can be anything, right? It can be the coronavirus crash. It can be the Fed changing course and making different decisions, whatever, right? Or it can be a company, missing earnings because of something, or it can be, a company being sued, or a company, making some bad decisions, or a company being acquired, or whatever, right? Whatever the event may be. But as investors, sometimes we look at things with denial. We look at things and go, "No way is this bad. No way is this going to continue. No way can I really be on the losing end," right? I did everything that everybody said to do. I bought the thing that everybody said to buy. I was on the right side of history for however long, right? Because just for instance, right, let's just say, Tesla stock, right? The stock right now is at the exact same level. We'll just say approximately. It's at approximately the same level that it was at January of last year, right? So over a year, and even though the stock has fluctuated, you're at the exact same point that you were, right? So to say that it's been a year and nothing's really happened in a stock like Tesla is a hard pill to swallow, right? You go look at Bitcoin, right? And you say, okay, you look back, I don't know, a little over a year, I guess. And we could say that Bitcoin now is at about the same, it's actually at about the same point that it was just a little over a year ago, beginning of February of 2021, right? So really nothing's happened in an asset like that. You look at the ARK Innovation Fund, and you say, well, when was the last time it was priced as it is today? Now that actually goes back a little bit further, right? So that goes back to June of 2020 even. And so in all of these things that seem to be high growth, that seem to be the right thing to do at the time or whatever, right? If you've continued holding them, then, maybe you've made no money. And that's a hard pill to swallow, and it's a hard thing to accept. So you can absolutely be denying and be in disbelief that what's happening to your money and to your investments is actually happening. So that's the first stage of investment grief. Then the second is anger, right? Investors become outraged, angrily casting out for anyone to blame other than themselves, right? Often they become swamped with helpless rage, protesting about the unfairness of the event and its harsh effect on their lives. And investors are way overly dramatic when it comes to the anger portion of investing, right? Because ultimately, you could be doing something as simple as buying an index and just not worrying about the individual, stock vicissitudes and volatilities that we sometimes pay attention to, and that sometimes push us into this investment grief. But you can 100% get angry at things that are occurring that are outside of your control, right? I'll just give you an example from my own investing life that may be funny to you guys, but luckily I cut bait in time. I've looked the entire time and just been like, I don't know what happened, right? So I owned Peloton long ago, right? Probably 2 years ago, owned Peloton, made some good money in Peloton. But I kind of rode Peloton to the top, and then we started to slide, right? And it started to slide and started to slide. And I was getting angry at the slide, and I knew something wasn't right. And so I cut bait and ended up making some gain, but not near the gain that there was at the high and all those types of things. And now you look at Peloton, which, at some points has been down 85+% from its high. And I'm glad I didn't ride that all the way down, but I was still angry at some of the losses because I did not understand. I didn't understand why what was happening was actually happening. And so it took some time and took some clarity. But obviously, once you cut bait with something, what are you going to do then, right? So there are times of anger. And there have been plenty of times when I've lost money in something where I'm like, it's frustrating. Now, many of the things that I buy, I'm buying and holding over long periods of time. So I've seen plenty of things turn from, losses to subsequent gains. And I've seen things go from huge gains to just marginal gains or even small losses, right? And that can cause some anger to arise. But you have to understand that nobody forced your hand to invest, right? Nobody did this to you. You chose to invest in whatever it is that you invested in. And so the only person you can really be angry with is yourself, right? You made the investment decisions. Now, I know this is a hard pill to swallow, especially if somebody said, hey, go invest in this, and you did, and you started losing money. Maybe you can blame them a bit, but you still clicked buy, right? You still submitted the order, and you still control your own money, right? So you have to take full responsibility for the fact that you made a bad decision, right? And sometimes bad decisions come at minor costs. Sometimes bad decisions, we don't fully reap the costs of bad decisions. And then sometimes bad decisions get us absolutely tanked, whether it be in the stock market or other parts of life, right? So be angry if you want to, but it's not going to make anything better, especially since you are the one that got you in this situation in the first place. Now, the third stage of investment grief is bargaining. So for some, the third stage of grief is the most tragic because bargaining gives investors false hope. At this point, many remarks begin ruefully with, if only I, or I do anything for, and similar pleas. In an attempt to avoid confronting their pain, investors compromise to give their life and soul in a futile attempt to make a pact with fate and turn back time, right? Have you ever, had a prayer like this or, talk to God like this, been like, God, if you'll just do this, then I'll do that, or all of these empty pleas that we give sometimes, right? Well, in much the same way, we do the same thing with investing sometimes, right? Like I'd trade, all my gains in this if only this had worked out, or I would, do anything if Tesla would just continue going up, or whatever, right? There are many things that we like to tell ourselves, and we do give ourselves false hope. Right, we keep letting ourselves believe that things are just going to turn out all rosy because we, work out all of these situations in our mind when things have actually turned out rosy, right? And so we believe that they can happen in our own lives. And what this can lead to us doing is, in a situation where things are going bad, it can lead us to buying more of something that is not of high quality, right? Or it can even lead us to a place where we're just holding and holding and holding on and just continuing on with something that we know is not as good as we originally thought it was, and yet we cannot talk ourselves out of us being right. Now, a lot of this does come from our own pride. It comes from our own hubris, right? Where we believe that since we made the decision that, hey, we have to be right. It has to turn out the way that we want it to, and we're going to do whatever we have to do to make it turn out right. And part of this bargaining process, I talked about buying more. This can be a perfect example of the bargaining process, right? Because we go, well, maybe if I buy more and that more goes up, then my average cost for whatever investment it is goes down, and then overall I make money on the investment, right? Even though we know that it is not a good investment for us, and it's not something that's going to be beneficial over long periods of time. We will continue to buy and we'll continue to put money to work, even though we may know that it's not our best allocation of capital. So in trying to avoid confronting the pain that we have, we may be actually causing ourselves more pain, right? And we're trying to give everything that we've got to make something work out that just may not be, in a place to work out, right? You have to understand that even though you have feelings, your stocks don't have feelings. They don't care about you, right? And you truly should not care about a stock, right? You truly should not care or have emotional feelings about a company. You can't control that company, right? You can't control that company outside of maybe if you have any say as a voter, in a proxy statement or whatever, and how much impact do we really have as small investors, right? But you have to understand that those stocks don't care about you, right? So do what you have to do to make money and do what you have to do to be a good long-term shareholder of whatever it is you should be a long-term shareholder of, right? But don't bargain with things that are not going to be good uses of your time and money over long periods of time. Now, that's the third stage. So we've got denial, anger, bargaining. And then the fourth stage of investment grief is depression. Okay, so depression marks the beginning of the end of the grief process. Comments such as, what's the point of going on, right? I can't live with this suffering, and why bother trying, show a clear need to disconnect from the world and properly mourn. Often depression is the longest stage of grief, with some investors taking years to clear this hurdle. Now, an example of this, I think, and I've seen this happen, and I've kind of gone through it myself sometimes, right? Is when you've been buying individual stocks and you've been seeing those individual stocks get absolutely hammered, right? And you go through this process, right? You're in denial that they're getting hammered. You're mad that they're getting hammered. You're bargaining with God, or you're bargaining with whatever investment gods you're talking to, right? That you just have to have them go up. And then ultimately you get depressed about it all. And you're like, I can't live with this, right? I can't keep going on looking at my Robinhood account every 15 minutes, right? Or sooner for some people. And then why bother trying? Why even try to pick individual stocks? And so you'll see people just completely stop picking individual stocks and just be index fund investors for long, long periods of time because they're trying to disconnect from this idea that they took losses, right? They're disconnecting from this idea that they could actually lose at something that they thought they'd be good at. And maybe they just didn't give it time, right? I've had to wrestle with this myself many times, right? You think that you make good investments, and a lot of times you do, but you just don't give them time. And this goes back to something I was talking about earlier this week with Warren Buffett and buying businesses and being a good long-term investor and not just, speculating in something over the short term, right? Buying something and not caring if it is volatile, not caring if it goes up or down or whatever in the short term, just knowing that you pick something with good long-term value that will eventually show up in the stock, right? But we forget this sometime and we get very emotional. Again, we care too much about these companies and think that they should care about us too, right? And then we end up in this place where we're like, just sell it. Who cares, right? I can't live with this. I can't do this anymore. And we get to this point of depression, right? We're depressed in our single stock picking or our single crypto picking or whatever, and we just don't want to do it anymore, right? And a lot of these things, right? A lot of this investment grief comes from speculation, and it comes from not being a good long-term investor and picking individual names, because if you are a good long-term investor, if you are investing in index funds or mutual funds or whatever, something that's well diversified, then you shouldn't have to go through much investment grief in your life, and especially no grief that's not being shared by the rest of the market. At least you'd have other people to talk to about that grief, right? But going through this depression is tough, and you can stick in it for a long period of time, but clearing that hurdle can get you to the other side and get you to the last stage of investment grief, which is acceptance. Okay, so redemption arrives in the form of acceptance. When investors finally come to terms with their loss, in the light at the end of the tunnel conclusion, they realize that life goes on and it's time for their struggles to end. So ultimately, we just, hey, it's okay, right? We cut bait with whatever it is that's just eating us alive. So of course, different investors have different responses to wipeouts. The most resilient get straight back on the horse, while others need time to lick their wounds. The most shell-shocked may never take risks again, right? Something seen, for example, after the dot-com bust, right? It's very common that some people get so downtrodden by the whole investment process that they'll never do it again, right? You see a lot of people become big gold bugs or Bitcoin bugs or whatever, based simply on the fact that they just don't trust the market anymore, right? They don't trust their ability to invest in the way that once made them money, but once also made them lose it all. Now, obviously, not everyone rides this particular investment grief roller coaster, right? A few experienced traders and hardened gamblers are so accustomed to cutting losses and moving on that they become remarkably resilient. In effect, they're immune to the emotional ups and downs of the market hazards, making them a rare breed. Right. So I think that is true, but most rational individuals, most rational investors are going to have some type of negative feeling about taking a loss. Right. I think that all of this really comes down to, having any type of major investment grief comes down to perspective and comes down to our understanding of ourselves as investors. If you don't know who you are as an investor, how are you going to know what you should be investing in, how long you should hold it, when you should sell it, whether you should sell it at all, whether you should buy individual names at all, or whether you should just be buying indexes, or what your asset allocation should be, whatever, right? We need to know who we are as investors, and a big part of that is knowing your risk tolerance, right? Knowing what your risk profile looks like, knowing that if I take any type of losses, maybe I'm not going to be very, good at taking them, right? I'm not going to feel good about it. It's going to negatively impact my mental health. I'm going to go into investment grief that's going to be quite substantial. I'm going to be depressed about it, whatever, right? We have to know that about ourselves, right? And take the proper amount of risk, because I think taking the proper amount of risk will alleviate a lot of this grief. Because if you are somebody like I was saying, the hardened gambler or whatever, who's just used to the cutting losses, used to moving on, used to all these things, then investment grief is going to be a hard thing to come by in your life, because you're just used to it, right? You're used to the losses. You're used to things going wrong. And that's no way, I think, to invest. But I'm just saying, maybe you're used to it, right? Maybe you are willing to take risks, and if things are volatile, then that's fine. Maybe you're willing to put large amounts of your income, or large amounts of your investments rather, in volatile stocks that they may be good long-term plays, but they're going to be extremely volatile until then. And that's okay for you, and you don't worry about it, right? And more power to you. But maybe you're somebody who just can't take it. You can't take the volatility. You can't take the short-term swings in the stock market, and you have to be in something that's lower volatility, or something that's more predictable, or something that has more long-term predictability of returns. And guess what? Neither thing is wrong, right? Neither thing is the wrong decision for you as an investor, but you simply need to know who you are and act in that way, and don't deviate from who you are as an investor. Because the problem is when the person who does not need to take a lot of risk based on their risk tolerance goes and starts taking a lot of risk because they see other people making money. They get greedy, right? Which greed leads to investment grief, right? and they see these people making money, they want to be a part of it too, and then they end up taking major losses, and then it kicks them out of the market forever because they're just not willing to get back in and take that risk again, when you could take proper amounts of risk and not end up in that place. So you should always be taking the proper amount of risk related to who you are as an investor. Look, I'm somebody who's willing to get my feet dirty, right? I'm willing to step into the mud sometimes. I'm willing to, really work to make higher returns in my investment portfolio with individual stocks that I buy. And sometimes that brings about some individual pain, but it can also bring some absolutely great gains along with it. And I've told you guys many times before, not everybody should buy individual stocks. Not everybody should buy individual securities and individual names. And many of you should not be speculating in any way, shape, or form, even though I tell you, 5 to 10% of your portfolio max can be used for speculation. I don't think many of you should be speculating either, because it is not commensurate with your ability to be a good investor, to take good risks, and to not fall into this place where you are grieving over potential investment losses. Because ultimately, I want you to avoid investment grief as much as possible. And then if you do grieve over certain investments, especially maybe ones that you've held for long periods of time or whatever, I want you to be able to quickly get over it, because you know that you've done the best you can do. You know that you have put the best investment operation into play that you can do. And then everything else just kind of falls where it may. So hopefully this is just a good understanding for you of how we end up feeling about certain things that are very emotional to us. And investing and our money, as we've talked about many times, is an emotional subject, right? And so if we know that it's an emotional subject, we know that it is going to lead in many times to some very strong emotions of denial and anger and bargaining and depression and acceptance, right? And going through that progression can be very, very important for us to get over some of the things that really eat at us mentally and emotionally about our investment life. But I urge you, know who you are as an investor, take the correct amount of risk, but be invested over a long period of time. Don't get scared of the market. Take the proper amount of risk, do the right things, and you will be rewarded. Time in the market is always better than timing the market. So get in, stay in, and make your long-term returns, and you will not be sorry that you did so. Might there be losses along the way? Sure. Will there be volatility along the way? Almost assuredly, right? Will there be short-term corrections and bear markets? Absolutely, right? But you push past all those things, you look at the long-term trend line, we are going to make money. And so just be a good investor. Think long-term, and just know yourself, and you will be better off for it. And hopefully you can avoid this investment grief over long periods of time. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.